This is the markets. I'm Chris Hussey, and today is Thursday, April 23rd, and my guest is Greg Tuorto, who is head of the small and SMID cap team in Goldman Sachs Asset Management. Greg, thanks so much for joining us.
Thanks for having me.
All right, Greg, an interesting time here for small caps. You know, the world has really gone mega cap tech, and yet at the same time, we've seen some small cap outperformance. What exactly is going on here? Is it still a good time to be in the small cap space?
We think so. We think it's been a three or four tough years in the small cap space, starting when the Fed started raising rates, and we really haven't gotten the tailwind fully from the cutting in rates you expect. You know, we're starting to see a nice earnings cycle in small caps. We think it'll be a lot more powerful than the large cap earnings cycle. We also think they're a lot cheaper, about 25-30% cheaper than large caps. Plus you have the optionality in the IPO market, which should help. And M&A is starting to pick up, which is also a really nice, tailwind for the small cap market.
So lower rates, better M&A, creating a little bit of a rotation in the small caps now. Is that what has been driving this year-to-date outperformance?
We think so. We think that there's also, a little bit of animal spirits. There can be, big moves that come in the small cap market that you can capture, both alpha and beta. I also think, if you want to put on your stock trader's almanac hat, right, the Yale Hirsch guide, when you have a really nice move, like small caps are up 10% in January. Usually that means it's going to be a pretty nice absolute return year. So that brings money back in. And there hasn't been any inflows in the small cap space in a number of years. We're starting to hear that from clients who are really interested to kind of come back into the space after having been out of it for a number of years.
Let me explore that animal spirits comment because, underlying an animal spirits is the notion that the economy is actually doing even better than we think it is. And yet we're in the middle of an energy crisis. How do small caps sort of shape up in an energy crisis? Are they positioned okay here?
I think so. I do think that we have to watch that economic output and the underlying parts of it really closely. The small cap space is not as economically, kind of sensitive as it once was. I do think that the energy side of it is quite small, and the transportation sector is the one you'd watch. The truckers and places like that where they actually have to pay those prices that we see on the pump as we drive into work every day. I do think that kind of some of the other areas have taken up some of the oxygen. Tech, biotech has done well. I think generally speaking, the consumer, John Flood, one of your former guests, was talking about the consumer this morning being an area that's really been, underwhelming. We like a lot of the consumer names, and I do think that piece of it is a sign that the underlying health might be better than we think it is for the economy.
Yeah, no, good point. Floody, the Fogo, he has been thinking that maybe the consumer is ready to go again. Let me explore that tech comment you made, though, because AI is also a big theme in the market, and I don't think of small cap stocks as being the cutting edge of AI. How are they shaped up in an AI world?
It's interesting. The moonshot hype cycle at the front end is an interesting place to be, but I do think that the picks and shovels side can be a little bit more of a long duration way to kind of harvest some gains. And I think that if you look at semiconductor cap equipment, which was nowhere 2 years ago and now is a leading sector in the market, and some of this optical connectivity that needs to connect these data centers together, there's a lot of opportunities there, a lot of ways to play it, a lot of different flavors of things to invest in. So I do think that this can be good even if software doesn't join the party as it hasn't, for the past, say, 3-6 months.
Yeah, no, it's a great point about the picks and shovels. And by picks and shovels, you mean the companies that can build the data centers, build the compute power.
And be the components inside of it that kind of drive this stuff forward. I mean, a lot of, the interesting thing is memory, right? We didn't think about memory as an expense, and it didn't kind of get to the headlines until people started looking at iPhone 17s and why are they more expensive? Well, memory costs more. And memory costs more because you're using a lot of memory in these large language models as so much is being stored in both nearline and sort of in the data center. So we think that there's a lot of ways, not just the direct memory plays, whether it's, kind of the big guys or even the people who are trying to help them build more memory. So, like the semi-cap guys who do that.
Yeah, it makes a lot of sense. All right, you mentioned previously rates as being one of the catalysts here that might be going on here, but I kind of think of the rates market now as sort of I'm not sure which the direction of rates here is. So now when you think about rates going forward, are we in the right exposure for small caps and rates?
I think on the banking side, the smaller bank side, I do think that things have calmed down a bit but not as much as they would like. The smaller banks are still, in some cases, fighting for deposits. In that sense, rates are probably not low enough for them to differentiate. So we don't have a big bet on the banking side. I think that there are other parts of the chain, maybe on the payment side or on the insurance side, where you're seeing a little bit more of relief, where some of these things sort of at the margin can be drivers of kind of the rate side can be a driver, or at least kind of not a headwind to them. So I think that piece of it is still TBD. We would love to see rates become a little bit less in the spectrum, in terms of what we look at. Financial conditions, generally speaking, are pretty easy. Spreads have not been crazy. We haven't seen any accidents in private credit, even though we've been watching it for months. And so that's good. So I think that, generally speaking, it would be nice to see a cut, but not surprised if we don't get one in the near term.
Yeah, no, great point. All right, last one on the fundamentals. I do think of this as a sort of a domestic index, the Russell 2000. I think of a lot of the moves like higher tariffs as trying to bring manufacturing back onshore. How is the sector, the index shaped up for a manufacturing resurgence in America?
There's a couple of areas. I mentioned semi and semi-cap equipment. I think that's one area. I think another area is on the defense side. We've had a lot of innovative companies go public, especially even recently on the defense side. And it's not all drones. Some of it's just the components that you need to kind of power these things. Connect that drone that's flying around back to a ground station so you can get the data. So I do think that's an area where you're seeing a lot of, built here, type of innovation. That's one part of it. I think the other part of it, too, that you've seen some innovation is, kind of in biotech, interestingly enough. Biotech had a big boom in 2020, 2021, and it's been sort of dead since then. We've had some M&A activity, and that's led to what we think of as a gradual beginning of the IPO cycle, where a lot of these companies who are, led by people who've done it once or twice before, or are looking to sort of, kind of what is done well in the U.S. and what areas, are a little bit underfollowed. And that should be an area we think that, could be able to exploit the, kind of the America theme that is underlying small caps.
Yeah, marry that to innovation and you've got a real secular winner. All right, let's put a bow on it. Mm-hmm. What's the trade?
Biotech. I like biotech. I'll talk my book there. Semi and semi-cap. And that defense space. I think we haven't seen innovation in defense in a very, very long time. And I do think that, it sounds somewhat self-serving to kind of look and see what's going on and try to make money off of it. I understand that, but I do think that there's a big change going on in the way we spend money in the defense industry.
Yeah, it's so cool. In a mega cap world, you're going to have all these smaller cap companies that have to feed into that supply chain. All right. Next week, believe it or not, we're going to turn the page on April. We're going to go into May. We also have the height of earnings season. What are you watching for next week and the week ahead?
Earnings is going to be critical. I do think you're going to have some of these companies that are very well set up, and I do think you have to make sure that the expectations match the reality. We've seen some healthcare be a little bit weaker. I think we've seen some industrials be a little bit stronger so far. Tech is also interesting because, talking my book again, semi and semi-cap have done well, software not so much. So I think that you need the continuation of the software side, but it would be nice to get some stability in software so people take their foot off the neck of that asset class because it's just been terrible for so long. The consumer, I think the data is starting to recover from the initial stages of the war. So if that can continue and just see people are continuing to spend at restaurants and at retailers, that should be good as well. The data would indicate that it should be. We just need to see the proof points of it before you go forward.
Whole lot of data, no question. But the real question, of course, is the Knicks. It's a big week next week for the Knicks. Can they get out of the first round?
I think so. I mean, it's a much more balanced team that they've had in a number of years. It looks like a winning team.
Love it. I definitely agree with that. Greg, thanks so much for taking time with us.
Thank you.
That does it for this week's episode of The Markets. I'm Chris Hussey. Thanks for listening.
The opinions and views expressed herein are as of the date of publication, subject to change without notice, and may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. The material provided is intended for informational purposes only and does not constitute investment advice, a recommendation from any Goldman Sachs entity to take any particular action, or an offer or solicitation to purchase or sell any securities or financial products. This material may contain forward-looking statements. Past performance is not indicative of future results. Neither Goldman Sachs nor any of its affiliates make any representations or warranties, expressed or implied, as to the accuracy or completeness of the statements or information contained herein, and disclaim any liability whatsoever for reliance on such information for any purpose. Each name of a third-party organization mentioned is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. A transcript is provided for convenience and may differ from the original video or audio content. Goldman Sachs is not responsible for any errors in the transcript. This material should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Copyright 2026 Goldman Sachs. All rights reserved.